Thank you, everyone, Zohar in particular, for all your work organizing, for inviting me to be part of this amazing program. And it's so great to see people in person, or at least people's eyes and foreheads in person. That's great. So you'll have to be really expressive with your eyes. I'm really happy to have the opportunity to talk about this work now, because it follows really nicely on what Oliver was talking about at lunch. So there's a good fortuitous structuring. And by way of caveat, the title of the slide is the title of the first paper, which is what Zohar invited me to present. What I'm going to present to you is about 3/7, that paper, about 3/7, a follow-up paper, which is part of the symposium last spring, honoring Roberta Carmel at Brooklyn, and about 1/7 the stuff that I'm currently working on. So this is a hodgepodge, and it's a hodgepodge in part because, as Oliver suggested, this is really an evolving area of both law and practice. So with that, let me see if I can get this to move on. There we go. All right. So the original paper was prepared for a book on global corporate stewardship. When I was invited to do the project, I wasn't really sure what a good corporate steward was. So let me give you a couple of thoughts on that. Then the question that I addressed in that paper was about index funds, and responded to a debate, as obviously a couple of years ago at this point, about index funds and their role in corporate governance. As Oliver said, the world has changed, and ESG in particular, and I'm going to use ESG very sort of broadly, very generally, presents particular challenges, both for index funds and for stewardship. And finally, I'm going to talk about some of the things that we can do in response to those problems, and in particular, the potential for empowering fund beneficiaries. So with that, what's a good corporate steward? Well, what exactly is stewardship? And this takes us back, I think, to a degree to some of the issues that Henry was dealing with 25 years ago. The idea that stewards can reduce agency costs and can help managers allocate and manage capital responsibly to create sustainable long-term value. Right? What are the tools of stewardship from an investor's perspective? Well, this has been sort of amply discussed elsewhere, and since they're taking my time over, you're not writing time over yet. Okay, but I'll move quickly through the introductory stuff. So with respect to index funds, why do we care? Well, we know there's a growing amount of money that is passively invested. A lot of that is in index funds. When we talk about passively invested money, we're obviously being broader than index funds. So what's distinctive about index funds? Well, index funds are pools of assets, right? They're assets that are owned by the fund's beneficiaries and that are managed by an external manager subject to an advisory agreement. Index funds select their investments based on the inclusion of those investments, the inclusion of those securities in an index that's typically constructed by a third-party provider. And Adriana Robertson has some really good work on the role of index providers. Index funds are cheap to manage because you don't have to spend a lot of time analyzing investments, and because they are subject to tremendous economies of scale. So can index funds be effective stewards? People have raised some serious questions, right? First of all, analyzing, collecting fund-specific information isn't part of the investment strategy. So there's no incentive to dig deep and to try to figure out what's going on in the companies in which you're investing. Index funds have no particular operational expertise, and they hold large and diversified portfolios, right? Finally, and Dorothy Lund has focused on this in particular, the whole point, the way index funds compete is by lowering their costs. If you lower your costs, putting aside the issue of stock selection, why would you spend a lot of money on engagement? That's not how you're going to attract assets to manage. Right? But there's a counter argument, number of counter arguments. Number one, and Jeff Gordon has talked about this a little bit, index funds can develop expertise in issues that are common to many of their portfolio companies. And we see them doing that. They've done that for a number of years, in particular with respect to governance. Number two, Asset managers typically offer and sell both index funds and actively managed funds. So there can be synergies between the two. Synergies that include the index fund managers benefiting from the actively managed funds' developed expertise. And number two, the fact that the index fund votes or voting power adds heft when the funds or when the fund manager as a whole want to engage. And Ed Rock, I think, has developed or pioneered the use of the term heft, right? So the truth about index funds, right? You hear these arguments, but what does the real world tell us? They tell us that index funds have increasing power, that they're engaging on a broad range of issues, and that the level of engagement, particularly by the big index fund sponsors, continues to grow. So everything's fine, right? I'm done with my talk. We can all go home happy, right? Maybe, right? So stewardship has changed. Stewardship used to be, as Oliver said, about managerial agency costs, at least in the United States, and economic value, right? The world's changed. We're now focusing on ESG. People are debating stakeholders and the role of stakeholder governance. We're seeing corporations pushed to go beyond their standard wheelhouse, get involved in politics and the like, right? And broadening the scope of engagement makes things more complicated, right? What societal issues are properly within the scope of stewardship? What should investors care about? What issues should they engage with companies on? How does can a fund trade off economic and non-economic considerations? And finally, who decides, right? So who decides? Well, here are the big three, right? Vanguard, BlackRock, and State Street. Some of you have seen me sort of stick Fidelity in here, right? They're not really the big three, they're the big four, but they have a lot of index funds as well, right? Those funds, as I said, are not the shareholders, right? Yes, they're the holders of record, right? They're not the economic owners. The economic owners are the hundreds, thousands, millions of individual fund customers or beneficiaries. But those beneficiaries don't call the shots with respect to stewardship, with respect to engagement, right? Who does call the shots? Well, in the case of BlackRock, we all know it's Larry Fink. So this presents what I call, in the second article that I referred to, an empty voting problem, right? Henry, wherever you are, there's Henry, right? Empty voting, right? Empty voting is back with a vengeance, right? Index funds are intermediaries, right? But stewardship decisions are made by fund managers who lack skin in the game, right? Roberta Carmel, building on Henry's work, says empty voting is the exercise of voting power by people with little or no economic interest in the shares that they vote. And as Henry can tell us in great detail, empty voting creates an agency problem, right? So why is this a problem for modern stewardship? Because, and Oliver said this at lunch, all shareholders may not have the same interests, especially when it comes to non-economic value. Fund managers, and John Zitnick, wherever he is, right, he's doing some work in this area on the extent to which fund managers can tell what their beneficiaries want, whether that's something they're capable of finding out. But at least right now, fund managers can't very well identify shareholder priorities, and fund managers may have their own reasons to favor ESG in particular, right? So here's just a nice picture so that I can talk less, right? Here are all of the different things we might think about when we think about being an effective stewardship, right? And my particular favorite here, the barbed wire there, that's private prisons. One of the big retail shareholder activists is focused on investment in private prisons, as that says that should be a bigger priority in terms of stewardship. So just flagging that one, right? But there are all sorts of choices that an investor has to make, right? Number two, and Jeff Schwartz has a great paper on this topic. There are all sorts of reasons why we might expect the agents, the fund managers, to favor ESG independent of the objectives and preferences of their beneficiaries, right? So they might be trying to sell shares in the mutual fund. They might sincerely think ESG is correlated with economic value. I'm talking so fast. I'm doing so well, Marcel, right? It might be that the political preferences or the social preferences of the fund managers are dominating, right? Host of different reasons. And in fact, of course, it doesn't have to be one, it can be multiple contributing factors, right? But to the extent that these are personal reasons of the fund sponsor, the fund managers, that's when we should worry. Right? So how might we respond? Right? And I've been told I have 5 minutes. I'm going to end even before 5 minutes, Marcel, right? Couple of possibilities here. Right? One possibility is we might say, okay, let's not have index funds or institutions or certain kinds of institutions vote at all. Dorothy Lund made this suggestion a few years ago, right? I think there are even better reasons today to at least ask the question, do we want index funds making these decisions? Are the costs greater than the benefits? Right? Second possibility, let's not focus on the index funds. Let's constrain the scope and the role of shareholder voting. Now, Oliver said, you know, there's something really great in a situation in which we have divergent viewpoints in having shareholder voting be the way to make a decision. But I think there are some serious risks associated with that. Number one, if we're talking about voting on operational decisions, right, shareholders are a pretty small subset of the overall population. Putting aside the separation between the stewards and the beneficiaries, do we want shareholders making what in essence are political decisions? And do we want those decisions to be allocated on the basis of the number of shares they own, economic power, right? We have democratic processes. I think we need to think hard about whether shareholder voting is an effective or appropriate substitute for those processes. Right? So a third possibility is I've been talking a lot about empty voting and the agency problem, and a number of people have said, well, just pass through the voting. Right? If you're worried, if what you're really worried about is mutual funds and maybe pension funds, let's just let the ultimate beneficiaries vote. Now, people have been talking about pass-through voting for at least 20 years, maybe more. Today, we have technology, we have blockchain, we have all sorts of things that make it easier for retail shareholders to vote. So maybe this is a time to reconsider this issue, but I'm not so sure. In particular, I'm not sure how engaged, how interested retail shareholders are going to be, particularly people who own shares in mutual funds through their 401k in a mutual fund into which they were defaulted by their employer when they don't even know what they own. Right? But maybe this is the answer. Right? And the final problem is we've always had low retail turnout. Retail turnout is likely to remain low, even if we create better mechanisms for voting. And there are a lot of people that are working in this space. I don't want to suggest that this, this is a moving target, right? Final possibility, preference registration. Oliver referred to that as well. We don't necessarily need to give people the right to vote. Why not just give fund managers better insight into what their beneficiaries want? This is a promising possibility. An alternative is doing it indirectly through product specialization. So if, for example, I invest in Calvert funds, I have a pretty good idea what Calvert's priorities are, both with respect to stock selection and with respect to voting. Right? Arguably, the same thing could be true outside of Calvert. But with a company like BlackRock, I'm not sure that I know, and I'm not sure today that I have a choice. BlackRock, Larry Fink might want all of his funds to vote green, but maybe that's not what all BlackRock investors want, right? So clear disclosure, clear opportunities for product choice are an alternative way of handling the agency problem. So I've put a bunch of stuff on the table. Obviously, my task going forward, moving from these first two papers in this space, is to try and answer some of the questions that I've put out there today. But since this is early stage work, I welcome your questions and your input. Right? And so those are my conclusions. And with that, ended on time.
So I want to get your thoughts on, when we're talking about this question, this is actually following up on what we were talking about at lunch, this question of to what extent should institutions have fidelity to the preferences of their underlying investors? I was wondering if you have thoughts on how the type of proposal at issue plays into this, whether they should be paying more attention on certain types of proposals, less attention on others. Maybe it's zero attention on any proposals.
So that's a great question. And one of my favorite co-authors, Sean Griffith, has looked at that question in some detail. It's not something that I have focused on in as much detail. And in part, I can see both sides of the question because you might say, based on your work, well, I think retail investors have really strong preferences on ESG proposals. And so that's an area in which the fund manager can defer. And Sean says the same thing. But individual ESG proposals turn out to be really hard to evaluate, harder than you might think, right? If you read the individual proxy statements, you see something that you might label as ESG, and this is a challenge with empirical work, might be a really silly proposal. And so if the investors say, hey, we want ESG, is the fund manager supposed to vote in favor of all those proposals, no matter how silly? And by the same token, investors might have less clear sense what they think about something like a merger. But, from an economic perspective, right, that might be really important. Things like the DuPont merger, I think retail investors had a pretty good idea what was going on, had some pretty clear preferences. So I'm not sure I have an answer across the board, but it's a great question. It's something that's worth looking at in more detail.
Just wanted to connect this briefly to the great ownership of enterprise work. And from the ownership of enterprise perspective, the interesting question is who owns BlackRock, to take an example, and is the ownership of BlackRock designed in such a way that the beautiful calculus of governance that Henry put forward is being optimized. And I think that if we look at enterprises like BlackRock, and that's why you have been working, I've been working on the agency problem of institutional investors, you see right away from the perspective of Henry's framework, that we have a big problem because the owners of BlackRock are the shareholders of BlackRock. It's a public company. But the most important patrons are really the beneficial investors in BlackRock, but they don't have any control rights. And the contract that they have with BlackRock, whether you have the Harding-Galles view or some of the other view that we have been discussing today, the contracts leave something to be desired. So I think that's another instance in which Henry's work kind of shows that there is, at least here, we have not reached an optimality as to where control lies and how it manifests itself in decision-making.
So super question, Lucian. And with respect to the ownership and the governance of these intermediaries, there are a lot of issues to be explored. So, junior scholars in the room, here's an opportunity for you. This is underdeveloped scholarship, and Henry's work gives you a great starting point. But Lucian, you focused on BlackRock, which has public shareholders, right? The ownership of the big institutions varies tremendously. Fidelity is privately owned. Vanguard is a mutual, it's owned by the individual funds. So you look at what's going on, I'm not sure that I can see a clear relationship, at least at a very, a 10,000 foot level between ownership structure and behavior, but I think it's a great question to explore more carefully.
Don't have much power. In any of those, whether it's Fidelity, Vanguard, is mutually owned, but practically,
But you're talking about power over BlackRock as an entity. I'm talking about power over the securities in which BlackRock invests with those beneficiaries' money. And I think there's a difference between those two types of control. And I think that difference, at least from a governance perspective, is extremely important.
So I disagree with Lucian. I think they do have an enormous amount of power, which is to walk away. Unlike in corporation, when you sell your stock, you don't shrink the size of the company. When you walk away from BlackRock, you do shrink the size of BlackRock. Now, if it's a pension fund, that's a different story, and corporate pension funds, you cannot walk away, etc. But at least for mutual funds, you can. And I think that that's the power that we should all exercise. In fact, I, at some point, when I write a letter, I don't know whether anybody will publish a letter to Larry Fink, because he tells how a corporation should be run. And I want to tell Larry Fink how he should run BlackRock, because I can walk away from him. And so hopefully we'll listen.
But that's the beauty of Henry's work, that he taught us that the power to walk away, which is in the hands of all patrons in his book. So also in the case of the club and the nonprofit, and in all those examples, Henry recognized that they all have the power to walk away, but he also recognized that the power to walk away is often not enough. And I submit in the case of BlackRock, is not enough for what Jill is talking about and you are talking about, which is being concerned about the identity of the stewardship decisions.
Well, it's funny because if we move from the governance of these intermediaries to questions about how good the market disciplinary forces are, we move to an even smaller set of scholars. And I don't know if John Morley is here and Quinn Curtis, right? But this issue of how effective the power of exit is in the mutual fund space, only a handful of people have looked at that question, and people seem to disagree about it strongly, including members of the Supreme Court. Right. So there's some people who think, yes, this is a robust market. If you don't think BlackRock is being socially responsible enough, you can, invest in Calvert instead. If you think it's being too socially responsible, there's that, what is it, the MAGA or the MAGMA ETF, you can invest in that, right? You've got real choices. And then there are other people who say, this is a really horrible market, in part because a lot of it is intermediated through things like employers, right, through your pension funds or your 401k plans. And so you don't really have free choice, right? And, I don't think anyone has really resolved that debate.
One of the major friction is actually taxation, because with capital gain tax, if I move from Vanguard to Fidelity or vice versa, even if I stay in S&P 500 stock, I pay capital gain tax.
Sure, but that's no different from market discipline and securities as a whole, right? If I want to move out of IBM,
if we were to say that if you invest in the same security, you don't pay capital gain tax, I think that will increase dramatically the power of changing.
Oh, absolutely. But aren't we moving the other way? Aren't we going to now tax at least your capital gains, even if you don't realize them?
Yes.
I was just guessing there.
Thank you so much. This is a paper together with the Doron, and it came out of a formal model we wrote in order to analyze under what conditions corporate governance is relevant. So this is sort of a spin-off from that paper. One of the realities which are part of the story of inequality that we observe today is the gap that has opened between productivity and wage since 1980. Now, many have provided explanations for that. All of them has explanatory power. We are not refuting any of them. Deunionization, globalization, immigration, technology takes about third of the result that we observe. Taxes. I want to focus on the last two, which is firms' market power. So one is the classical labor monopsony, where the firm has power over the employees and therefore can afford not to pay them their marginal productivity. But this explanation rests on the claim that the companies have market power and therefore needs to show concentration in one way or another. And empirical studies are challenging the claim of concentration. The other one is firm market power on the products, like sort of product monopolies. And this is the line of explanation that was provided by common ownership scholars, basically suggesting that common ownership leads to some form of collusion between companies to raise prices, like in the airline industry and the like. And here there is the work of Marcel and the work of Ed and others that have shown that it's really very not clear why would the Vanguard or BlackRock be involved one way or another. These are all household names in illegal collusion for so many years, and none of that was going to be detected. We would like to start with these two and offer a new explanation, which is basically that common ownership leads to a labor monopsony, but a different type of a labor monopsony, which is being the result of the common ownership and not the result of the collusion. And the argument goes this way. Common owners are concentrated and powerful. They push for strong governance across the board. Strong governance reduces investments and increased payouts. Lower investments leads to labor monopsony because lower investments leads to lower hiring and lower monopsony. The conclusion of that is shareholders win, employees lose, inequality increases. No need for collusion between firms, no need for institutional sophistication, no need for firm market power or concentration. So the process by which we focus on governance as the leading cause for this result looks this way. So think about a company with weak governance. Let's say shareholders cannot fire agents. If you happen to have a loyal manager, the loyal manager will invest in project A and will increase value. If you happen to have a disloyal manager, then the disloyal manager will invest in project B, destroy value, and consume private benefits of control. But shareholders cannot clearly identify when a manager invests in A and when a manager invests in B. So when you move to strong governance, what you would see that you are deterring the disloyal managers from making inefficient investments or over-investment, as we call it. But you would also deter the loyal manager from doing some investments which are hard to evaluate, innovative, long-term, and so on, might not be done by the loyal manager out of fear that they are going to be mistakenly perceived as investing in project B and they will be mistakenly fired. So what we see here, we see a trade-off over governance, and the trade-off is agent costs, reducing agent costs, but on the other side, inflicting principal costs. And the principal cost is the amount of investment that is lost, which is efficient investment that's not done out of the fear that mistakes by the shareholders would lead to firing a loyal manager. Now, governance has a feedback effect to the labor market. And the feedback is done the following way. If you have weak governance, you will have a lot of investments, empire building by the disloyal manager or pet projects, and innovative long-term projects by the loyal manager. So there is a lot of demand for employees, prices of labor go up, investments become less profitable, shareholders get a signal to decide whether they want to switch their governance. When you are under strong governance, then there are fewer investments. The disloyal stop investing in pet projects, but the loyal also does not invest in the good projects. Less demand for labor, and since you have less demand for labor, price goes down, investments become more profitable, and again, shareholders get the signal from the market. If you look on the market as a whole, given this feedback, when firms switch to strong governance, more managers are deterred from investments, lower demand for labor, lower price for labor, investment is more profitable, and there is an incentive for companies to switch to weak governance. When many companies switch to weak governance, more managers are encouraged to invest, higher demand for labor, higher price for labor, investment is less profitable, and now you have an incentive to switch to strong governance. And this process will stop in a competitive equilibrium where it will make no difference whether you are strong or weak governance. You will not be able to make more money by switching from one structure to the other because the prices of labor equalize the expected profitability of each structure, meaning investments are zero NPV. Now, what common owners are doing, they are basically disabling the feedback effect. They push towards strong governance, investment decline, labor prices decline, investments are more profitable, and at the stage where we would expect companies to start switching to weak governance, they prevent that from happening. And now they can keep the labor monopsony sustainable and income inequality increases. From the perspective of antitrust, we do not need to exercise control to facilitate coordination. No need The only thing you need is to change the allocation of control, meaning move to strong governance. And then the control rights are delegated to hedge fund activists or to raiders to do the other part of the work. And given that, you will not see any evidence of collusion or something illegal that is taking place. Something which is seemingly harmless, push for strong governance, transfer value from labor to capital. To see this in facts and how it manifests itself in the economy, imagine that in 1980, one person owned all of S&P 500 corporation, but that person had no intervention in product competition. All companies are left to compete and maximize their own value. But only one thing was happening. That person dictates that investments growth rate by a few percentage points should go down. That's the only thing that you do. If you do that, what will we see? Okay, so of course, the first thing you will see a decline in the rate of investments. Then you will see an increase in payouts. Then you will see lower percentage of employment by publicly traded corporations. Then you will see the wedge that we started with. Then you will see, because you're not paying the fair share of employees, you will see markup going to the sky. And of course, you will see value of corporation going up. And not surprisingly, because there is a transfer of wealth from employees who are less wealthier to shareholders who are more wealthier. So you will see the inequality also rising. And all of that is with this one person that owns all the market. And of course, these are the institutional investors. The term common ownership was born just very recently, but practically since day one, since their strategy was diversification, it means they were common owners. They were not big enough to get the title common owners, and once scholars started suspecting that they affect competition, but practically once you hold a diversified portfolio, you are a common owner. So with less than 25% in the 80, today more than 70%, then you can see that this wedge correlates really very nicely from the moment they started gaining power all the way to today. So what's the answer for that? So we propose that, like many other anti-competitive structures that we see in the economy, that whenever you have a situation that you cannot regulate behavior, you cannot regulate activity, and as we said, there is nothing that you can point to and regulate some collusion or something to this effect, then you have to regulate the structure. And regulating the structure in this case would mean limiting the size of money managers. Limiting the size, today they reach $9 trillion. If you look on the top 500 money managers in the world, then the median size of them is $50 billion, which suggests that you can get economies of scale even with $50 billion. And we propose $500 billion, $500 billion. Even with that number, you're going to increase dramatically the number of players that will have to compete and return the balance of power between shareholders and managers and remove the effects of the labor monopsony that is now created by the common ownership.
Thank you, Zohar.
I'm kind of puzzled a little bit. Are you saying that Amazon and Tesla, I think, have strong governance? You saying they're investing too little?
So if you would pick specific company and ask me to say, is this one company is investing less or investing more, I won't be able to answer that. I'm relying on empirical studies that look overall on strong governance versus weak governance. And what you can see that strong governance involve lower investments and higher payouts compared to weak governance.
But don't most venture capital startups have strong governance, and they're the ones who presumably are growing the fastest in the economy? I'm a little bit confused about that.
So as I said, if you would push again on a specific company, whether this specific company is making more or less investments, I don't have an answer for you. It's going to be speculation. So that's why I'm relying on empirical studies that looked on wide range of companies with strong and weak governance and showed that with strong governance, lower investments and higher payouts.
I think that your analysis, and similarly, the analysis was alluded this morning to the papers by Jeff Gordon and others that look at this, but in terms of internalizing externalities on climate change. So in all those cases, you think about how those common owners will want to maximize the value of their portfolio. And what I think is missing, and I think importantly so, is the fact that the common owners have their own big agency problems. So those agency problems lead them not to maximize the value of their portfolio. And my own thinking about this is that usually their incentives are not to engage in all those things, but rather just to do the minimum necessary to maintain the wonderful business that they have and to be able to pay lip service to the idea of stewardship, but not to do the kind of beautiful or bad maximizing. In your story, it's maximizing of the portfolio that leads to bad effect. In Jeff's story, it's maximizing the value of the portfolio that leads to internalizing climate change. In my view, we have none of those happening, but rather much less is done in terms of stewardship.
So with that, I disagree, because I think that the minimum that you're talking about, that they do, and I completely think this is the result of the mandate that they have to vote. And that means that what they do is the one-size-fits-all policies that they adopt over corporate governance. There are many studies showing how they push for stronger governance since 1980 all the way for today, on many aspects of that. If you just go and see how as they grew up in power, what it did, it moved more and more power to shareholders. So, but in what they did, it was the minimum they needed to do. But that's minimum. That's the point we're making, which is what the minimum they did is transfer control rights to shareholders. Others did the rest. Hedge fund activists, raiders, others did the rest. But the minimum that you're talking about is pushing to strong governance. It was done like across the board along the last 40 years.
I can follow up on that. If you fight like that, why don't you believe that the three little vendors say that the one big vendor?
So the idea is that if you think about the power that they have as collective, when Larry Fink is sending a letter to corporate America, it is like reading this reader. Okay, so thousands of consultants now read this letter. What Larry Fink wants us to do? Okay, if Larry Fink will manage $500 billion, manager will not care about what you write in his letter. So it's about relative power between a collective of money managers that holds large stakes in the corporations, and it allows managers in a much better way to negotiate. If you didn't manage to persuade Larry Fink, so $8 trillion is lost. But if you manage to persuade one and fail to the other, still you have the chance of persuading enough managers to side up with your proposal and do that.
Zohar, I can understand your story in terms of decreased investment, increased payouts by established publicly traded corporations. But those payouts don't disappear. They presumably don't really drive huge increases in consumption. So that money must go somewhere else and be invested. Now, I know you have data suggesting
lower levels of investment, but I just kind of wonder whether that's due to different definitions of what's investment. Because I guess I just don't understand how this could really, higher payouts could really result in lower aggregate investment in the economy.
As we discussed that, as I told you, I'm not an economist and I'm not doing empirical studies, clearly not macro. So I'm relying on the conclusion of those empirical studies that have shown that strong governance is correlated strongly with strong governance and payouts, and less investments, like Philippon and Gutierrez, that have shown that in a very clear way. Beyond that, I cannot contribute more.
Oh, I've got it. Okay. So I just looked up just for the S&P 500, just the proportion of employment that they account for. And it's about 17%. So there's a lot of the economy that's not in, so that's not everything that people invest in, but there's a lot of the economy that's not in this picture. And so it seems to me that you might get some partial equilibrium kinds of effects here, but the general equilibrium story has to be different, right? That you just shift things to other parts of the economy.
So I completely agree with that.
Okay.
You can think about this labor monopsony as trying competition with the effects of the labor monopsony that is done. So one way you can think about why would startup companies who used to be 7 years and before they go IPO, why move to 14 years? Okay, you can think about that maybe in the private market, they can be in a different situation, not under that pressure that is coming from BlackRock and others in terms of the effect on investments. So you see them outside. You can see the entry to the markets, which is the level of companies who wants to go IPO with dual class, almost double, even triple than like in the 80s. Why is that? Because these are companies who wants to enter the public market, but wants to avoid the effects. So all of these trends that we see are trying to penetrate this monopsony and trying to and not surprisingly, you see that Vanguard and BlackRock and all that, they are pushing back against dual class. They don't want them enter the market. They have like a huge campaign to exclude them from the indices and all of that. I see all of these trends as competition against a monopsony that is trying to avoid new entry into the market and people taking some of the rents that they are getting through this activity.
I was confused by the suggestion that limiting the size of the firms is the move. I would have thought, given your statement earlier, that diversification just is common ownership at an earlier stage, that you weren't drawn to the Eric Posner idea of limiting diversification and capping the number of firms that these big firms, intermediaries can invest in as a way to get them to be less tacitly collusive with each other. Now, I heard your answer to Marcel. I didn't hear Marcel's question, but I heard your answer was something about the size of the firm allows the intermediary to BlackRock to get attention for its letter. I thought that was a confusing implicit answer to the question, because that seems to talk about a particular transmission channel for the monopsony to be, going through a channel that depends on size. But your answer to Vic suggested that you're not interested in looking at the particular anecdotes of particular firms. You want to look at what's in the data. And we don't have something in the data that shows the letters are being read. So I just wanted to see why you wanted to go that direction that has a kind of story that we can kind of visualize, when we could just do the Eric Posner thing as a way to limit monopsony.
So the story of Eric Posner is different in two ways. Okay, so the first story that he has in mind is that common ownership creates this collusion between the competing firms. That's what he's concerned about. It's exactly what Marcel was writing about, what Ed was writing about. But it's about the competition between firms. We don't think that there is no competition between firms. They compete. We don't think that common ownership, the transmission mechanism, goes to the product market pricing. We don't think that. So that's one difference. We think that what is going on is like a more passive behavior. We just push for strong governance, and we would increase the deterrence over managers that would achieve the effect. I don't think they even understand that this is what's happening. From their perspective, they read many articles by Lucian saying strong governance is good governance, and they do that, and they see that the value of their portfolio goes up. And from their perspective, that they don't think that they are creating externality on employees. I don't think that this is something, we don't blame them on doing something on purpose. We just say that's the consequence of what we're doing. So that's one difference. The other difference that we have is we looked on the proposal that Eric had, and it would solve our problem as well. But it would be much harder to implement, because as John Morley explained, given the structure of the funds under the umbrella of BlackRock and other, it's going to be impractical. So the solution we picked, not surprisingly, goes after a solution that was done in Israel. In Israel, when the government forced the banks to sell all the mutual funds to the private market to compete with the banks on credit and others, there was a limit to the size of money managers. That's what they did. Do whatever you want, and you want to invest 15% here, 2% there, we will not interfere. But the total size of your management is limited. So we followed that line of proposal, and it works well.
I would like to understand and distinguish between what we say it's ideological or a class interest from a monopsony, because maybe it's my poor understanding, but you seem to be flip-flopping between the two interpretations. Because one thing is to say there is a common interest of class as a capital owner to have stronger governance and lower investment, and that has bad repercussion for labor, blah, blah, blah. But that has nothing to do with how many funds you have. Is maybe the fact that Mike Jensen became so popular, or Lucian Bebchuk, or you pick who to blame.
I pick Lucian.
Okay, and then that's the outcome. Okay, versus but then your solution is not going to fix that. You have to convince Lucian not to write his articles or not to publicize. It goes to a different solution, because breaking up the mutual funds will not change this cohesive class interest, because they will all listen to Lucian Bebchuk and we will all do what Lucian Bebchuk said. Versus a case in which it's an individual objective, is in the interest of an individual firm to increase its investment, but it doesn't do it because it's owned by a fund that say, no, you shouldn't do it. Okay? If that's what you're saying, I think that's at least up to now, and maybe the future will be different. Up to now, it seems to be counterfactual, because I don't know index funds to have fired any manager. In fact, my complaint has always been that they didn't fire enough managers for the bad behavior. The only one who do are activist investors who are not diversified. So if they follow a class interest, then I buy that, but it's not fault of the index fund. But they're not well diversified. Actually, activist investors, they're highly concentrated. They push to maximization one company at a time. So which one of the two are you defending? So
that's the point that you are making about who's making sure that managers are being fired is indeed the activists. In the 80s, it was the raiders. Then it was the independent directors. Then it was the hedge fund activists. Yeah, they're doing the work, but they're doing the work on the background in which institutional investors, either for raiders, they supply funding and sell the shares, or for hedge fund activists, they support their proxy fights. They are there. Without them, you cannot do that. Bengt Holmstrom and wrote a beautiful article explaining that takeovers of the 90s could not have happened without the institutional investors' presence in the market. So in terms of the mechanism, that's the mechanism. Now, do they tell them don't invest or I will fire you? No, that's not what's going on. What's going on is the natural effect of deterrence that is created through the fact that managers understand certain type of investments, shareholders might perceive them to be inefficient investments and it will cost them their job. That's the mechanism. The mechanism is not saying invest less. The mechanism is you are accountable. Because you are accountable, you could be fired. And because you could be fired even when you're doing a good thing, you will not do the good thing. You just want to preserve your job and you will not do it. So we're not taking a position that this is what they do. All we say, what they did, they transfer control rights to activists and raiders and others. And by doing that, they increase the probability of a manager being fired mistakenly. And the result of that is the principal cost and lower investments. That's all we say.
Olga?
I have a question, or maybe similar to Luigi's, about the timing. My question is the timing. Luigi asked a more abstract question. So you have, I think you started with a graph that where from the 80s, inequality has been going up. But common ownership started much later, like 20 years later. In fact, the Gutierrez and Philippon story also measures an investment gap, if you believe them, only starting in the early 2000s. The Raiders that you just mentioned, that's in the 80s when there were some institutional investors, but surely much fewer than today. And it surely was not the common ownership story. So I'm having a bit of trouble fitting these empirical pieces together.
So the way the term common ownership is a new term. But what does it mean? Someone who invests in multiple companies and commonly owns a range of companies. That's all it means. Day one, okay, 70s, when institutional investors started to invest. We have a beautiful piece by Jeff Gordon detailing that. What did they do? And also by Ron. What did they do? Diversify investments. Okay, you didn't call them common owners, but they were common owners, even with 1%. If you own the whole market, you are a common owner. You're not a strong common owner, but you are a common owner. From my perspective, the way we look at that is that since day one, they were common owners. They just got the term recently because they were powerful enough such that people were afraid that they might will have anti-competitive effect on collusion on the product market. But from day one, that's what they did. Now, as far as studies looking on investments, there are several studies. Okay, so one study shows that it is, which way it goes, the other way. One study shows that it goes from the 80s. That's one study. The study that you referred to by Philippon show this, which is from the 2000. There is another study that shows that it already started in the 90s. Okay, so no one created a specific empirical study to test the story that we are selling here. But you can look, from my perspective, it doesn't matter if you say it's 80 or 90 or 2000, it's the same effect. Now, the way it manifests itself, it's something that only a tailored empirical study will be able to find, but that's what we show.
We have time for one more short question.
In the Zoom room, do you have time now?
Thank you. Zohar, I would like to suggest a slightly different mechanism.
Can you speak to the mic so we can hear you?
I would like to suggest a slightly different mechanism from yours and a simpler one and in a way more pernicious one. And it's the following. When you have a concentration of assets in the asset management industry, what that does in terms of the portfolio construction of the asset managers, what the portfolios that they're holding, what you find is that the bigger the asset manager is, the more asset under management, the larger the share of highly capitalized companies.
Okay, so BlackRock owns disproportionately Apple stock, for example, right? You can see obviously why that would be the case. Now, what's pernicious about that is that it induces a sort of purely asset management driven incentive for the companies themselves to merge and grow bigger. And one thing we have seen happen in the last 20 years in the US stock market is a lot of mergers of listed companies and a huge decrease in the number of listed companies. And it could well be that that's driven in part by the growing concentration of the asset management industry itself. Now, that could be problematic, right? If you let that go unimpeded, eventually that is going to lead to a form of monopolization or monopsonization, as you put it.
So I take your suggestion, which is obviously probable, to be a version of the classical labor monopsony. So the transmission is bigger asset manager leads to bigger firms. Bigger firms have market power over employee. Therefore, we see what we see. It could be, as I said, there are empirical studies trying to test the question whether concentration is such that it is affecting the labor prices. We are not challenging that. We're just offering an additional explanation. But this could be the case. Well, the same way.
Thank you very much.
Thank you all.
Well, thank you. I'm delighted and really quite honored to be here in recognition of Henry's extraordinary scholarship. And I want to begin with a little introduction that gives you a sense for what brought me here, because on his otherwise spotless record, sadly, Henry is responsible for that. I first came upon Henry's work, not when the original sin of my education is that I was first a business student, an MBA student in finance, rather than a law student. So I first read Henry's work in the context of a class on finance, where I was told for many years that the main purpose of investors, the way for me to understand what investors were sort of undifferentiated mass of anonymous entities whom should be fed earnings and EBITDA and very little else. That's how I learned to think about investors until I was given Henry's book, and of course the 1988 piece in the Journal of Law, Economics and Organization that preceded it, explaining that the patrons of the firm, whether its owners or the participants in its enterprise, were fundamental to its character. And I opened that book thinking that I was looking forward to a long career on Wall Street, and I closed it sure that I wanted to be a student of the law, a fact for which Henry will have to apologize to my very confused father, who thought I would have been a very fine investment banker. The decision I made to pursue law after learning from Henry led me, among other things, to a position on the Securities and Exchange Commission, from which I stepped down just last year. And what I thought I would do today is bring Henry's lessons, both from that famous 1988 J. Leo piece and the book that we're honoring at this terrific event, talk to you a little bit about how those insights affected the way I thought of those regulatory challenges, and in particular, the regulatory challenges implicated by common ownership and the work that's been discussed thus far. When I was on the SEC, we considered 3 different regulatory questions that, for me, implicated Henry's classic insight about the ways that the patrons of a firm could tell us about its character and its likely implications for society. The first was the debate we had and are having as a community about the role of activist investors in modern business enterprise. I can tell you that one thing that was remarkable for me in my experience at the SEC was the degree to which that debate over whether we should encourage or discourage activists in their tasks, the degree to which the law should, to borrow a phrase from Henry's J. Leo piece, the degree to which the law should encourage the contracting among patrons and owners of the firm was absent from that conversation. For that reason, I think the debate over activist investors has been clouded and can be clarified by reference to Henry's insights about the ownership of enterprise. I think that's been done best actually by Ron Gilson and Jeff Gordon in their 2013 piece, assessing the complementarities between the activist enterprise and passive investors, and the degree to which passive investors can be thought to be, in their phrase, rationally reticent, but willing to be prompted by activist investors with respect to their engagement with the management of the enterprise. For me, that tells us a great deal about what we should want and expect from activists as a participant in the business enterprise. And going back to Henry's work in preparation for today's event, I was reminded of his invocation frequently of the various degrees to which the firm's patrons could be providers of something other than capital, insight, expertise, labor, and the like. And I was reminded of a recent shift in the market for activists, where they are not only urging particular organizational changes they once did, but instead seeking active participation in the enterprise's management, seats on the board, with extensive degrees of control that they previously didn't have. And I documented this in an article with Columbia's Jack Coffey and Josh Schmidt some time ago. The degree to which activists are participating in the enterprise in this different way, I think, should inform our regulatory response to their involvement. That is, to the degree that they're providing merely capital or financial expertise, or even ideas from outside the boardroom, I would think a little differently about their value to the enterprise in the terms of Henry's insights than I would if they were more actively participating in the management of the enterprise. I have urged upon my former colleagues at the commission the view that we may want heterogeneity in the treatment of activists with respect to the value proposition they offer to the organization. And I want to say one of the themes of the talk that I'll give today is that we should recognize the limitations of regulators when we contemplate suggestions we'll make to them. In particular, the likelihood that an institution like my own organization, the Securities and Exchange Commission, can and will give the kind of detailed heterogeneous treatment to regulatory questions that might be ideal if we take full account of Henry's insight about the heterogeneous organizational design at American business enterprise. So to take an example, I would urge upon my former colleagues at the SEC a very different approach to take just one example, the Williams Act Section 13D disclosure regime. Depending on the character of the underlying enterprise, the status of its owners, the degree to which there are large or not large block holders in connection, underlying owners in that enterprise. But I have to tell you, I don't expect to get this kind of detailed regime from my former organization. Instead, I expect to get a rule that's more likely to reflect one-size-fits-all change, irrespective of those underlying characteristics. I want to say that it's incumbent upon us as an academic community to urge these regulators to think a little more carefully than that about the potential approach they could take to such a fundamental question of underlying ownership. Another issue that we face that I'm reminded of today, especially in the common ownership debate, is what to do about proxy advisors. I was at the center of a significant debate about whether proxy advisors should be regulated as solicitation, as engaging in solicitation under the federal securities laws. I again was reminded of Henry's insights with respect to the attempts that patrons of the firm will make to contract for various degrees of control and influence over the enterprise's management. For me, ISS, Glass Lewis, and the debate simply just reflects an attempt for the underlying owners to contract around the collective action and other problems they face with respect to taking action at the firms that they own, and in particular oversight of those firms' governance. What was fascinating to me about that question is that those two firms and the ownership structure that they have, the underlying design of those organizations, was really absent from the debate about what we should, if anything, do about regulating them. Instead, the focus, as you might know, was on the role that those firms played in American corporate governance. There was a sense that they played too much of a role, should play less. And therefore regulatory tax should be imposed upon their work. Whether or not one agrees with those priors, and I can understand why you might, I have my own skepticism about governance solutions devised by both those firms, I was struck to think that we know very, very little about the underlying organization of the firms, those two firms, the degrees to which they could or could not respond competitively to the regulatory burdens that were imposed on them. And I was relieved when the steps that were taken under the last administration at the SEC to provide really very heavy regulatory burdens on those firms, not just with respect to their ongoing operations, but providing for them a very significant risk of securities fraud liability in connection with their work. I would think that as a scholarly community, we want to back up and ask ourselves whether or not that's likely to lead to better or worse outcomes for the underlying owners of those enterprises. And then finally, there's a debate that we haven't had today, and I think it's been mentioned in passing, but I can't help but raise it as someone who's going to talk today about the regulatory limits, or rather the limits of what we can expect regulators to do about modern business enterprise. And that's about the index providers that are dictating with more or less zero oversight, where hundreds of billions, if not trillions of dollars are invested in American enterprise. For me, it was astonishing at the SEC to ask the question, it seems like these folks are making really important decisions. At the time that I was at the SEC, they concluded, for example, that firms with certain governance perhaps should be excluded or included from the indices. Very little oversight is exercised over those firms. Very little is known about the degrees to which, or rather how they reach those decisions. And I think they have very significant implications, not just for the governance of the firms themselves, but also for the way we should think about this. And I want to say why. To me, the classic way of considering investor remedies in response to the risk of agency problems at the firms that they own is exit versus voice. I always imagine, just like Jack Coffey and Bernie Black have, that the shareholders have those options. They can either exit the firm or exercise more meaningful control. But if we think through the fact that index providers set the diversification portfolio for the overwhelming majority of investors, it's noticeable that there's a very significant constraint on exit. That is the reason we can, or rather the way we should think through this is a theoretical matter, I think, is that exit is exceptionally unlikely in a world where the underlying owners overwhelmingly are dictated by their position inside or outside an index that's determined by a third party, which has very little accountability either to its own underlying owners or to the market more generally. If that's true, then we can see in equilibrium, we should expect voice to play a more substantial role in the work of the firms that are engaged in index investing. That's not to say, and to say nothing at all actually, about whether or not those firms can be expected to provide an optimal degree of governance. But I think it's important to note that the limits that we can expect exit to play, or the role we can expect exit to play in a world where index funds own so much of the underlying stock of publicly traded companies. So I want to conclude with one historical note that hasn't been talked about much today, which is the degree to which common ownership as a debate implicates not principally actually US corporate law or securities law, but instead antitrust law. And I want to point you to an institutional limitation we should expect to confront if we actually pursue the kinds of remedies that Zohar and others have talked about, which is that it would require careful, coordinated collaboration between two different federal agencies of the federal government, the Federal Trade Commission on the one hand, and the Securities and Exchange Commission on the other. The history of these two institutions is not as appreciated as it should be. The Federal Trade Commission actually was the SEC before there was an SEC. You see, the 1933 Securities Act gave jurisdiction over the US securities laws to the Federal Trade Commission before the 34 Act created the Securities and Exchange Commission, my old home. And you would think with that heritage, there'd be lots of really thoughtful contract scholars and securities lawyers at the FTC thinking through the difficult questions of competition raised by, for example, common ownership and other related questions. You'd be disappointed, I think, about the depth of the bench at the FTC on these questions. And in fact, among the other policy solutions I urged on that subject was that there should be a joint task force as between the SEC and Federal Trade Commission to consider and address these kinds of problems. Whether you think Zohar's right or not, to take those proposals seriously, you'd have to have an institution prepared to do it. And I think these issues lie at the intersection between the jurisdictions of those two organizations. Rather than say more, I think I'll leave some time for questions, but I'm happy to have a conversation today about how Henry's great insight, besides having turned me into a lawyer, for which I'm so sorry, can tell us about the future of regulatory interventions in this area.
We'll give a chance to the Zoom participants. I see a hand up by Martin. I don't know whether that's about Rob's talk, about an earlier talk.
That's got to be for Zohar.
But and also Sarat had a hand up, but he put it down. So Martin, you go first.
Yeah, sir. Thank you very much. And sorry for the bad lighting situation here. And indeed, I meant to speak to Professor Goshen's talk as opposed to Commissioner Jackson. So apologies for jumping back. I just wanted to make three comments. So I heard the word collusion about 24 times in that talk when referring to the literature on common ownership and product market competition. And what I wanted to say is that this strikes me as a major confusion and a widespread one also. So that literature is explicitly not about illegal collusion between firms. And it's also not about coordination, which is another term I heard. What that literature is about is reduced incentives to compete, not about increased incentives to collude. And those two are entirely different economic mechanisms and different theories of harm. So they're important to distinguish and not to mix up. The second comment is that intervention in product markets by common owners is neither implied nor assumed in that literature. So as Lucian Petruk pointed out, the impression, which I share, is rather that the common owners have reduced incentives to improve firm governance compared to non-common owners, right? So compared to activists, for example, that have a less diversified portfolio, as Luigi pointed out. So it is actually this passivity or being excessively deferential, as Lucian calls it, to firm managers that explains the product market effects. A model of collusion does actually not explain the evidence the empirical research has brought forward so far. And all of that is formally modeled in my work with Florian Ederer, Mireia Janet, and Miguel Anton. So we hope that this model clarifies these distinctions. And the third and last comment I wanted to make is that diversification is not the same as common ownership of industry competitors. Quite a bit of common ownership of competitors comes from investors that concentrate their holdings in particular industries. So Value Act is one prominent example, or Berkshire Hathaway is another. Nor does the rise of institutional investors imply common ownership. There's lots of activists who are not common owners, but concentrate their holdings in a particular firm and then push that firm to be governed more effectively and to produce more efficiently. So those are the three clarifications I want to make.
With Zohar's permission, I will turn to other questions, and if there's time at the end, I will give Zohar an opportunity to react to your comments. So, Sarat, that's a question about Rob's talk.
It is, and it's just a brief observation as an outsider. This speaking to the regulatory challenges, or perhaps more precisely the limits of a response. I look at index construction a lot like I look at meme investing. It's these third parties that are sort of encouraging others to certain degrees to invest their own monies. They don't quite have that same sort of personal stake. There's a sort of free speech involved here. And just like meme investors, like they could have colossal consequences, but I don't, at least to me, I don't see what the regulatory response could be other than just prohibiting certain types of speech. And I guess my question for you is, particularly on the index construction side, like what are the options for the regulators, even just like the simple options, I guess, if you could speak more on that.
Sure, happy to say a bit more about it. So, Sarat, I have to ask you, tell me, how is index provision like meme investing?
Maybe I'm stretching the analogy here, but S&P is just that they might as well be on Reddit telling people here are 500 firms you should be investing in right now. for no particular reason other than we say so, right? And it's just a third party encouraging others to make investments that have, they're neither direct advisors. So there's no like fiduciary relationship, for example, between the advisor and the advisee, right? This is just some third party saying, here are the stocks you should pick without even, and they may or may not even give a good reason for that. It's just, there's just this kind of network effect, that kind of the snowball effect, right? Everyone's piling into S&P 500. Why? I don't know. Why do people buy GameStop? I can't explain that. It's probably not grounded in some, it doesn't seem to be obviously grounded in like fundamentals. So I just see this as like just sort of people saying crazy things, but how are you going to regulate that speech is what I think where the real power is.
I see. So I want to separate out two things. First, of course, I agree that I just wanted to be sure that we weren't equating the wisdom of the S&P 500 and GameStop. Although then again, GameStop's got better returns. So what I'd say, So Zohar is asking me, Rob, what can we do about this, if anything? Because doesn't the First Amendment bind us to allowing third parties to provide investing advice with relatively little oversight? And I think, Zohar, the answer is I certainly hope not. And you'd have to ask John Morley about the degree to which the 40 Act can provide effective disclosures and other solutions for these kinds of problems. We explored that when I was on the commission, and I think our view was that the 40 Acts had limited, were likely to be of limited help in this way. I actually think you would need, if you wanted to consider these questions, you would need a law. Zohar, you'd probably need to empower the securities regulators, the SEC, have some authority over the how these kinds of decisions are made with respect to index construction. And I would think, Zohar, the one reason that that would be desirable is, at least when I was on the commission, the index providers were making a number of controversial governance decisions by way of index. And there's a nice paper by Scott Hurst about the degree to which that might be something we want to encourage or discourage. What I'll say about it from my point of view is that the amount of law we should have governing it, I think, is likely greater than zero. But maybe you have a different intuition.
Well, just the final comment, I'll let others jump in. Just absent a fiduciary relationship between advisor and advisee, the person creating and constructing the index and the person using the index, or absent any sort of misrepresentation, material or fraudulent. My question is basically like, what's the legal hook? Like, what's the hook that you can grab onto to constrain the index providers to do whatever it is that we need them to do?
I see, Zohar. Sorry. So I think you're pushing me to think through a little bit what would be the legal basis for this kind of intervention. And Zohar, I think it's not unreasonable to argue that index providers benefit a great deal from the existing subsidy they get by 401k plan rules and through other sort of safe harbors that have been established under both the federal securities laws and ERISA. And so I would think that that would provide a basis for providing some oversight over the assets under management of these funds and the licensing fees they're able to charge, I think, are dictated to some degree by a subsidy provided by those laws. And I think we could find a hook for that kind of oversight there. The only point I meant to make today is that to the degree that they set the portfolio for many, many millions of investors and dictate the underlying ownership of many, many public companies, we should probably give some thought about the degree to which exit is an unrealistic prospect in those firms and what that tells us about the role of voice.
Okay, yeah, great. So thanks, Rob, for this. So my question is to really connect your argument on index providers to Lucian's point earlier on the agency costs of asset management. And is there maybe an argument that index providers might be might have a more powerful incentive to maximize value? Because while the asset manager is, keeping a share, a very small share of the portfolio returns, the index provider presumably may be selling and licensing the index to more clients. And in fact, the index provider is in the business
of selling the index as a product or service, and so therefore may have a more powerful incentive to use the index as a means of active portfolio management, like Adriana has argued. So I'm wondering why, just a priority, we should be concerned about index providers beyond take the point that we don't know much about them, but it would seem that they would have a more powerful incentive as their independence. It means that they have a product that they're selling to the market, where delivering those returns directly translates into more use of their product as opposed to a competitor's product.
So I think your question ends with the premise on which it rests, which is their licensing fees and returns are driven largely by the degree to which they can convince people to use their product, which is itself the product of a competitive market. And I was hinting earlier in response to Sarat why there's reasons to question whether that's the case, whether instead the indices that are largely used are used because of subsidies that are provided by 401k rules and ERISA plan rules that nudge people into those portfolios as opposed to others. Now, you might say, well, Rob, then that's a question for a different area of law, or maybe not something that should concern us as a matter of organizational design. But I think what Henry teaches is that to the degree we're setting up the underlying ownership of the enterprise through this sort of intermediary, we should pay attention to the intermediary's incentives. Josh, if you're right, if those index publishers have better incentives to engage in the kind of governance work that we need, I'd be keen to agree with you. It's just not obvious to me either a priori why we'd expect that.
Do you think I agree the 401k plans push people into index investing? Do they prefer S&P to other indices? Is there any evidence that tomorrow you can't launch a competing index that would deliver more returns? Are there relationships between S&P and the 401k providers that would preclude other indexes? Because that, I think, would be the critical linchpin to your non-competitive point, right?
I think those are good. As you say, Adriana has done the really important work in the area, and I'd want to know more from her about that. I think what I'm worried about is that regulators aren't thinking about it at all, in fact. And to the degree we care about the underlying character of the ownership of the enterprise, I think that we should.
Yeah, thanks very much. I just had a question about the institutional response that you were ending with. Basically, what I took you to be saying is that there's at the beginning of the talk, that it would be good to have more regulatory heterogeneity in an ideal world, but the resources and the nature of what the SEC can do right now means that that's not practicable. But then I was trying to connect that to your solution at the end to if you have a joint task force and sharing of capacity across certain kinds of government agencies, SEC and FTC, for example, maybe that can help get past that. That could have been a disconnected point. But if those were connected, I'm wondering to hear a little bit more about the risks that you might see with that kind of collaboration. I mean, obviously you get knowledge sharing and that's good, but do you worry about pull from one agency to the other? What are the kinds of, I mean, if you think about it with other agencies, this kind of stuff happens all the time, like State Department and USTR, one just completely takes over once they start working together.
Yeah, so I think you're absolutely right. And the proposal I made for there to be shared resources was not necessarily that there'd be joint decision making, but instead that there'd be sort of shared data, analytical capabilities, et cetera. I have to say that part of the problem with overseeing common ownership, when we talk about the mechanisms and what regulators can and should do about it, is the lack of institutional competence to take the kinds of steps that we think would solve it. And I'll just give you a couple of. And that, by the way, puts to one side, I suspect, as always, from Mark Rowe, you'll get insights on the political economy of these kinds of questions, which is its own separate problem that I haven't talked about much yet, but I trust we'll get a sense of from Mark. You know, for me, part of the problem here is that you're unlikely to have the kind of institutional capabilities necessary to do that. Let's take 13D as an example. So I've made an argument for some heterogeneity of treatment. It's actually not my argument. It's the argument that's been made in the literature by others in the room. But I just mean to say that to the degree you are trying to figure out how desirable activist intervention is and how much regulatory tax you want to impose, you should think about the underlying ownership characteristics of the firm. I think it's very unlikely what we'll get from the SEC is going to look like that. I think right now we have a 10-day window. we're going to get a number less than 10. Is my very, very strong sense. Now, that doesn't mean I don't mean to be critical of my point. It's a challenging job that they have, but I think I just meant to point to the sort of institutional limits of regulatory intervention. When I hear a proposal like Zohar's or like Eric Posner's, now that I've had the job that I just left, I try to think hard about the institutional capabilities that those kinds of proposals raise.
We have time for one more short, very short question and short answer, Ron.
And it'll be quick. My impression is we're seeing more and more smaller firms self-indexing because of a mutual fund self-indexing because the margins are so narrow that the amount that they're paying for the indexes are expensive. So at least as I see the new people entering the fund, particularly in the ETF space, they're more and more self-indexing.
That's quite right, Ron. And just to be clear, I think it's Adriana whose papers have provided the most clear evidence on that subject. And as she points out in those papers, that raises its own problems because often self-indexers face conflicts about the constituency of the underlying index.
But as to those, you've got, because they're also the issuer, then you do have the 40 Act.
Right. Yes, you do. That's absolutely right.
Okay, we are moving fast to our next and final panelist. Roll.
Hey, everybody. I have a slight problem because I thought I read the memo as 20 minutes, and when I went through what I was planning to say yesterday, I thought I was going to be a hero and coming in at 17 or 18 minutes. But I'll cut a couple of slides and I'll talk a little faster than usual. And I see Zohar has this great feature of a running transcript, which we don't really have to talk anymore. We can just read the transcript. This is very nice. So, okay, good. I'm glad somebody knows how to turn it on Zoom. This talk is going to intersect with common ownership, but it's not primarily about common ownership. Title is corporate purpose and corporate concentration, and it'll intersect at the end with some of the themes of the day and some of the things from Henry's book. There are a lot of moving parts in the underlying paper. What I'm going to try to do is strip down to what we should always do to the essence and. Why is this not advanced? Cool. Okay. So if A, then B. The simple idea in the paper is if there's more rent in the firm, it's going to be easier to accommodate purpose-oriented pro-social pressure. It's not that the rent in itself necessarily or in any important way creates the ESG pressure. It's coming exogenously. But once it's there, once there's rent, there's going to be an easier capability of the firm to accommodate purpose pressure. We've already heard from some of the other presentations, there are wide claims today that competition has been declining in the United States over recent decades. And I'll go with that for a couple of minutes and then open up the A to an A prime and a couple of other A variations. If that's true, that competition is declining in a significant way in the United States over the last several decades, then a lot of large firms can more easily accommodate purpose pressure, ESG pressure, CSR in 2021 than they could have before this competitive decline occurred. In a highly competitive, hyper-competitive industry, if ESG can work, if it's going to boost the branding of the company or boost productivity or make people more motivated inside the firm, or it'll work because it's not very important because it's just cheap talk. There are things inside highly competitive industries that are going to defeat expensive ESG. Firms are going to lose access to new capital relatively easily. Firms' cash flows are going to decrease if it's really spending significantly on ESG in a way that hits profits. The consequences, the firms that do it will shrink compared to the firms that don't do it. Last bullet point on this, firms in a highly competitive industry are going to act as if corporate law had a shareholder wealth maximization command, even if it doesn't. Even if corporate law is silent in hyper-competitive industries, management really doesn't have a choice. So, general idea: firm has a buffer of above competitive profits, which it can distribute. If there are strong pro-shareholder structures in place, the distribution will be to shareholders. If the firm is managerial focused, a lot of it will be distributed to managers. If there's a looseness in the structure somewhere, the firm has the opportunity to distribute some of those rents to others that are putting pressure on the firm. There's more discretion inside the firm that has rents. A little bit more. So I'd start with competitive decline. Certainly, there's a big literature out there that there's been competitive decline. It doesn't, as far as I can tell, it's not been linked up in the corporate governance literature, and I think we ought to link it up in the corporate governance literature. There's another kind of counter literature in the IO stuff, which is no, competition is not declining. In fact, competition is increasing in the United States in recent decades. And what we are mistakenly seeing as a decline in competition is competitive winners in winner-take-all industries. And so there are more skill foresight and industry monopolies. There are more technological monopolies. There are more monopolies in which a winner emerges, dominates the market for a decade or so, and then gets displaced by somebody else who comes up with the next technology or the next marketing capacity. Getting this right for IO antitrust purposes is really important. Is it A or is it A prime? Which industry is an A? Which is an A prime industry? For purposes of this paper, it doesn't make a critical difference in the core structure of the paper. As long as there are more rents, whether they're skill foresight and industry rents or anti-competitive rents, there's something that is now a feature of the corporate governance system, in that there's more looseness on how to distribute those rents. And then there's the intersection with common ownership. If common ownership is effectively a cartel of the owners, the rents could be created by the common ownership. So sometimes when this is done, the ESG is looked at as a change in costs and a change in the supply curve. The way I like to look at it for purposes of this thesis is when there are rents, the red, there are a lot of people who would like to take a slice of the rents. And it doesn't have to just be shareholders and managers. It can be others that push on the firm and are able to take a piece of the rent without crippling what would be if the firm were in a hyper-competitive situation. More rents, constraints on the distribution of those rents are lower. If employees make greater demands on the firm in a hyper-competitive industry, even managers who would say, yes, I want to pay $15 an hour to my employees. Some firms are going to find that if they do that, they'll be clobbered in the product market. If there are more rents in the firm, they can give more vent to their preference. What is this coming from?
There's somebody on Zoom doing.
But it makes it a lot more interesting, I'll say. Okay, evidence. So there are three propositions that to make this more than a theory paper with words, it's Is there evidence that there's a rise in rents? Is there evidence that there's a rise in purchase pressure? I guess the fact that we're here talking about things in this way says yes. And then, will the rise in rents lead to more stakeholder accommodation? The underlying paper can't really evaluate all these things here, but the underlying paper goes to this. There's already mentioned significant evidence of a decline in competition in the United States. There is indubitably increased concentration. Question is whether that really decreases competition. The answer to that literature in the IO, which I find in some ways very convincing, is that the nature of the large firm has changed. Higher markups because higher economies of scale, so variable costs are lower than they used to be, and the way we measure a markup on variable costs looks bigger, but it's not really incorporating the baseline organizational costs. And the horizontal shareholding literature, which I don't have to mention at all for this group. My sensibility is, while I don't want to go out, I don't want to really arbitrate the IO stuff. My sensibility is that this middle piece of increased rents because of the changing nature of large firms in the United States is underrepresented in our corporate governance thinking. So we've got 4 varieties, 3 which I put on the table, 4th which requires a lot more time to go through. What could be happening in some industries, what I think is happening in some industries, the nature of long-term rent sharing got disrupted at the end of the 20th century, and their efforts to recreate it. But anyway, we've got 4 relevant industrial organizational changes in the IO literature, each of which have an element of rents are up, either A, for bad reasons, A prime for good reasons, A double prime, common ownership, A triple prime, changing nature of labor and share ownership. All right, let me skip this. Evidence of the then. There's significant amount of correlation of firms that are have high profits with CSG and CSR. A significant amount of that literature is painting a picture that do more CSG and do more CSR and ESG, and you'll be more profitable. It seems quite plausible to me that the causal direction is primarily the reverse, that firms with greater profits because they have greater rents from one of these sources had more room to decide how to handle those rents. One piece that I think is useful, relatively recent, Anna Stansberry and Larry Summers, my colleague, Rick Large, have a retrospective on employee relationships in firms, and their conclusion is large firms that have rents are just able to pay employees with the same set of skills more than firms that lack the rents. There's more to say, and there's stuff on the other side, but for that, got to read the paper. Mechanisms, maybe I ought to just skip over the mechanisms. There are several mechanisms by which the rents could end up producing accommodation of the ESG and the CSR. One is a managerial agency cost. If I've got the rents to distribute and I've already taken as much money as I can take from the firm to live nicely, I'd really like the employees and people I deal with as customers to smile at me. And doing a little bit more ESG and CSR will make my life a little bit more pleasant. Some of it may be the monopolist understanding that it has to do some of the ESG and CSR in order to retain the monopoly. There's more to say on that, but that's good enough. Consequences and next steps, and some conclusion. Looking backwards, Looking backwards, I think there's an opportunity to reinterpret for the corporate law professors in the group, the Dodge v. Ford case, which we almost all teach in corporations. We tend to think of this we tend to teach it as a shareholder primacy case, and then we say, no, realistically, we show that we really understand how people fight. What was happening was Ford was squeezing out the Dodge brothers by closing down the dividend compensation to the Dodge's minority stockholders. Alternative interpretation with this structure that I have in mind, by 1913, Ford had one of the most successful monopolies in American industrial history with extraordinary returns on invested assets. The assembly line worked. He was then about to embark on building what, upon completion, would be the largest vertically integrated industrial structure on the planet. He needed labor to be with him. Chuck alluded to this earlier today, the $5 a day wage was one of the mechanisms by which he made sure, increased the chances that labor was going to be with him in building out the factory. And the way I interpret it, because we squeeze things into our latest construct, is Ford had a monopoly, and he understood that he had to share a significant portion of those monopoly profits with labor if he was going to keep that monopoly. This is motivating Diego Rivera's famous murals at River Rouge. It wasn't going to happen unless he decided to share the profits. Second, looking forward, and we've seen some of this today already, there are now more demands on the corporation, but if this rents analysis is right, there's more capacity to satisfy those demands. And looking forward, it has the potential to change, alter our thinking, my thinking on hedge funds and shareholder activists' role in corporate governance in this way. My preferred role for shareholder activists and hedge funds is to pull management that's straying from the right path to shareholder profitability. Classic, this view, I'm stuck in the 1980s. If rents are indeed very high in large firms in the United States, a new role, additional role for shareholder activists and hedge funds is to make sure as big a proportion of that monopoly rectangle goes to shareholders as is possible. The difficulty with that is to the extent that becomes a significant role for hedge funds and shareholder activists, they're no longer that they're redistributing the monopoly rectangle, but not necessarily, and maybe not at all, improving the productivity of the corporation. More conflict in the firm, more conflict outside the firm. So just slide to well, maybe I don't have to repeat this, but put this diagram. So the diagram I started on kind of looked like this. Lots of arrows. Well, the arrows were pointing at that monopoly rectangle, and the analysis is that ESG and CSR in a corporate setting in which rents are high for whatever reason creates a mechanism in which people will want to share and contest those rents. And the intersection with Henry's work is we then have more heterogeneity in corporate governance, which creates more issues and more problems.
Thank you, Mark.
Thank you.
Jeff?
Thanks. I want to interact Mark's work with Zohar's work here. So one takeaway from what Mark is saying is that if Zohar is right, the activists should be focusing their energies on the firms with rents to make sure that the shareholders get the lion's share of them. And that has the effect that he's describing. But if in fact the activists are focused on the firms essentially that are failing, that are not generating rents especially, but are underperforming, then that suggests the activists are doing a different thing. And thus the distributional effects that he's describing are not related to the activists' engagement. So if the activists are trying to take an underperforming firm and improve the performance, that's not about assuring that the shareholders get an increasing share of the rents. And so it seems to me that that's the kind of the way to put these two things together. We look at the class of firms that the activists are going after in a way to determine whether what they're doing today is protecting the shareholder rents or a different thing. So that relates to both his claim and it seems to me yours as well.
So I'm wondering what you think, and maybe it's related to your A prime, of William Baumol's work. So in the old days, it was on contestable markets, and he thought about airlines. But Baumol's more recent work is on innovative firms in the economy that may look like they're monopolists and they have rents, but in fact they don't, because they have to continually invest in technology and R&D to maintain their positions, which would suggest they don't really, they might think they have rents, but they don't. And I'm not sure sort of if you looked at your data, are those the firms that are more responsive to ESG? Because then it might not be rents, but it might be some of the things I guess Zohar and others have said about, or I guess Jill with, Larry Fink's preferences, but it may, so I'm wondering if you could sort of relate that literature to think about whether these are really companies with rents or where they fit in that dimension and how that works into your thesis.
Yeah, just trying to get my mic on. Mark, I wonder if you could say a bit more about the B phenomenon as it exists. That is what you call B, I think it was B was your letter. In other words, you say that there's been a rise in pressure for corporate social responsibility. The CSR idea has been with us since the beginning of corporate law scholarship. I'm going to mark the beginning of corporate law scholarship to early 1930s with Burley and Means' work. There's, of course, the famous exchange in the Harvard Law Review in 1931 and 1932 between Merrick Dodd and Gardner Means on this, who was it between? Merrick Dodd and Adolph Burley. Who knows? Means is the economist, I guess. He wasn't writing in the Harvard Law Review. There's been like a sine wave of interest in CSR. My reading of the history is that the shift in conception of corporate purpose more firmly into the shareholder value paradigm that occurred through the 70s and 80s for various reasons, including some changes in the capital markets that sparked a set of bust-up takeovers and so on and so forth, that fall in managerial agency costs might have been a major driver of increased pressure for CSR that manifested in state legislative changes back then. What exactly do you point to factually today with the history that leads to the view that pressure for ESG is highest now? And this is a genuine question. I'm not sure I have a real view about it. I just wanted more from your take.
Okay, Mark gets to respond, and we'll take another set of questions. That's a fair question. That's a fair question because I don't really develop this increase in ESG. I just kind of extrapolated from the fact that this is not quite all we talk about, but almost all we talk about nowadays at these kinds of conferences. And that when I pick up the New York Times business section in the Wall Street Journal, I see things like engine number one and the effort to deal with Shell that we didn't see before. But that's a fair question. Is it really increasing? The sine wave idea is something I would sign on to. I think there's a plausible case to be made that it's increasing relative to where it was, say, in the 1980s or 1990s, but not necessarily to where it was in, say, the 1950s. And it's plausible that what happened is competition became more substantial in the 1960s and 1970s, and 1980s, and during that era of greater competition, ESG and CSR were not as big on the agenda. But I can't really, there probably are ways to measure, but I certainly didn't try to do it in the underlying paper.
Okay.
Bert has something on that.
The support for shareholder proposals that are not governance and that are more in the ESG has gone up. So to the extent, so that would help your thesis.
Okay.
Next on the queue. Yes. So this is fascinating. In terms of the normative implications, before people start writing to Congress and to the FTC and ask them to relax antitrust rules so that corporations can help the world becoming a better place, I want just to caution that you were careful to say, if you have more rents, if you have more slack, you have an opportunity, if you want, to use it for stakeholders. And then you said, on the margin, if people smile, this is, you will like it. So from my perspective, I think it's not a very big margin. So that the question is, how much of the slack would corporate leaders use to get some extra smiles from employees and from other people? And my intuition is that they are probably not going to use a very large or a meaningful and economically meaningful part of the slack that they will get for making the world a better place.
Asaf, still have a question? Yes, this is an imperfect analogy because there are differences between companies and institutional investors, but I was wondering whether one could relate your analysis to Zohar's through another dimension, and that is maybe one of the reasons we see more ESG activism on by large asset managers is because they face less competition, right? So if you believe that BlackRock and Fidelity and others now enjoy economies of scale and other advantages, now it's time for them to either, depending on your theories of the channels, invest more in ESG or more pressure on them to satisfy ESG demands.
Don, you still have a question?
Work. Well, I'll just talk loudly. So one of the things that struck me that was interesting is I would expect if rents are increasing, what we'd really see is more, CEO private jets, what Luigi would call theft. But my general sense is we're seeing the opposite trend. We're seeing that go down. So why, assuming I have those general empirical facts true, why would we be seeing that divergence?
And Naomi, and then Mark gets to respond.
Okay, I was interested in the A primes, which you described as the winner take all for a time. It seems that those firms are different, that they're the ones that are likely to have dual class shares and have a lot of concentrated control. And so I guess it seems to me it's important to think about how those kinds of governance structures might yield different results in the face of monopoly rents than another kind of firm with the standard diversified stockholder pool.
Okay, good question. Good questions. A few things on Lucian's question. Yeah, one of the parallel to one of the themes that's come up in different segments today, to the extent it's decreased competition, although I tend to think we're probably seeing more A prime, different nature of industrial, but to the extent it's less competition, what we want is an invigorated, what I think we want is an invigorated antitrust policy, not a corporate governance policy that says, let's grab these rents for the people, for our friends. But I must say, consistent with Lucian's intuition, when I've talked about this in other audiences, there are some pro-ESG CSR types who thought, well, what this means is we ought to have mechanisms that will decrease competition so that we can have structures where we can grab the rent. And I must say, well, laugh at it as I like to. I think there are things that have happened in the history of different countries where this feature has been true, that different groups wanted to decrease competition because they can get a bigger piece of the increased monopoly rent. The difficult one in interacting here is the A prime. What if we're getting efficient increases of rents, and what do we do there? What else? Corporate jets. I mean, my sensibility, but I may be off here, is that CEO and managerial compensation and take out of the large corporation is pretty good. And maybe they're not taking in corporate jets anymore, but taking it in other mechanisms. And so I think the compensation aspect is consistent with the story.
Okay, I think we're at the end of the session. So thank you very much.